Hey IMP options traders, thank you so much for watching this video. I want to walk you through one of my favorite monthly income strategies, being selling puts. Why? Because it's incredibly simple to do and it can make you a lot of money in the process. So selling puts works best in markets that are trending up, trending markets, and they also work best in oversold markets, meaning that markets that are coming down to its bottom and lows and going to bounce soon. These are two ways this strategy performs very well. The way that this strategy works is very simple to understand, especially for a beginner. You pick a level you think the stock won't get below. So let's say the stock is currently trading here. You're like, wow, this is really far down. This is how far of a move. This is the market has to drop 12% before we hit this level. So I think this is a safe level. I pick this level. As long as the market stays above this level, I will make money. So that means that the market can go up and I'll make money. The market can go sideways and I'll make money. The market can go down and I'll make money. The market can even crash 12%. As long as it stays above my level, I will make money. And so that is how this strategy works. You're simply just picking a level. You want the market to stay above. That level will be your strike price that we pick for the options contract. So that is what selling a put is. It's a very profitable strategy. And what I want to teach you here is how I trade it. I try to target the 90 DTE level. So this means 90 days until expiration. Why do I like to target this level? Because it's the perfect blend between 120 days, which is 3 months out, and 45 days, which is like a tasty trade lesson. And so 90-day mark will give me that extra credit that I want to collect, but also have enough theta decay where I will make money decently fast, and it will eliminate a lot of gamma risk. Gamma risk being how likely the options contract is to move during the day, meaning that my P&L will not fluctuate that much. So 90 days until expiration. I like to target a 7 to 10 delta. This is my range. Again, how do I change what delta I'm picking? Well, again, the smaller the delta number, the further away from the stock I'm going. Since the market is pushing into this upper band, which you'll learn more about in the indicators lesson, we are more likely for the market to pull back. And since we're likely for the market to go down, I'm targeting currently a 7 delta because that gives me more room to the downside for the market to fall. Next, I have a 25% take profit level. What does this mean? It means once my trading gets to a 25% profit, I will take it. And so let's say I collect $1,000 to put this trade on. That means I will close the trade once I see $250 in profits, then I will close it. Now, a 400% is my stop loss. So that means that if I enter a trade at $1,000 again for the same example, once the trade gets to a $4,000 level, aka a $3,000 loss, then I will take that loss. So I either have a $250 gain or I have a $3,000 loss. And you may be saying, well, that's a huge loss, Austin. Yes, it is. But if you stay tuned, I'll show you how to mitigate those losses. But not only that, you have a 95% plus win rate on these trades. Now, again, I don't like you taking my word for it. Let's walk through an actual back test. So here's a back test of exactly what I showed you. Let me just make my face smaller. You see here we have a 10 delta put. We're going 90 days until expiration. We're trading daily. This is how we get the best back test. Again, you'll probably do this once to twice a week. Max profit of 25% and a max loss of 400%. We're trading this on SPX. That's the best way to simulate trading it on futures. And this back test is from the last 10 years. So if we look at this, it has generated a profit of $1 million. Our average P&L per trade is $416. And you can see here that I make 290%. Now, for average wise, we did this backtest over 10 years, so that's roughly a 29% return a year. Now, what is the cons of this backtest? Well, if we look at the backtest, it moves pretty well, moves up. If we compare it to the overall market, it is outperforming the market compared to what the market did. However, where did this strategy fail? That's what we should always be focusing on and asking. And right here, we had this move down, and the COVID move down, and then we had some problems here when the market downtrended. So how can we prevent or mitigate these risks, right? If we can remove these huge down moves, then this will just be a straight line up, and it'll be a very profitable strategy. Although it already is, we can make it even more so. So even without making any adjustments, we have a 98% win rate on this trade. So this, again, is an amazing trade. 98% win rate to make $400 with the chance to lose about $4,000. And so that's kind of what our risk to reward scenario is. And now, how do we mitigate these risks? Oops, let me remove that line. We mitigate these risks by using this trending band indicator, which you'll unlock in the next course that you have from the leaderboard by being active in this community. But this is the trending band indicator. And once the market hits into the top portion of this range, like the candles hit the blue line, then we want to exit all of our long positions and wait for 21 days to help the market resettle. Why? Well, because when we do that, we're able to avoid most, if not all, well, not all, but most of these pullbacks in periods where the market did bad. You can see here that the market underperformed in this little downtrend. Well, we would have been able to avoid this bit of it by waiting that 21-day point, so we could have got out and avoided those losses. And then again, we would have had just a bit of a rough trading time, but we would have made money in this time. And then where else are we seeing it? Well, again, we didn't really hit it until 2020, the COVID crash. You can see here, not only did we break above or hit this blue line, but we broke above it. And so again, this was a sign to get out of our long positions, being our short puts, because it's a long position. We would have got out here, wait 21 days, and we would be able to re-enter here and make money to the upside. So this would help us completely avoid the 2020 crash. And again, here as well, we wouldn't have been able to avoid it. Here's a situation where it wouldn't have actually hit the top band, so we would have just had those smaller losses here. This area is similar to or where this loss period is, so not a large loss, but still something we could not have avoided. But this one right here, when the market broke above, we could have avoided all these losses down here because we would have been able to get out in this scenario. So using this trending band will help us identify the best levels to get in and out. Why? Because it shows our risk. The closer we are to this blue line, the higher of a chance we have for a pullback, which means the higher of a risk we have selling puts. So that's why when we're selling puts toward these levels, we want to go further out, and we want to be more safe and make sure to manage quickly if we hit these top blue lines. Anyways, that is how you sell a put, and that is how you manage risk on it. Now, that managing risk isn't just about a stop loss and take profit, but it's also about understanding account size. And so what I mean by that is you shouldn't put your stop loss should not be more than 10% of your account. So if you're trading with a $10,000 account, and 10% of that is $1,000, that means you should not be risking more than $1,000 on a single trade. And like I said, just trading one of these options, you'll have a $4,000 risk. So that means that you should have a $40,000 account if you want to trade a put to manage risk correctly. And if you don't have that large of an account, well, first off, you need to build up to that, because that's how you sell options. You need a large account so that the insurance premium actually makes a good payoff. But also, you can use, instead of using ES, which is the futures that we sell options on, you can also jump down to MES, because it's a tenth of the price. So now, instead of making $400 on profit, you'll make $40, and instead of a $4,000 loss, you'll see a $400 loss. But instead of needing $40,000, you only need $4,000. So it's a tenth of the price. So if you have a smaller account, look at using MES. Now, that is what selling puts is. This is a very profitable strategy that a lot of great traders do every single week. There's traders who do it every single day because of how amazing this strategy is, especially as we get into this middle range of the market. It's amazing to sell because we have that upside, and their downside is quite limited because we've already moved down a lot. And so selling puts is a strategy you should learn and add to your repertoire. If not, start paper trading. Now, how do we automate this strategy for people who work full-time, who have a family, who don't want to be glued to the screen? How can we set this up here? Well, we go into our auto trader here. Again, this is still a beta form of it, but we click create a new auto trader. We connect our Tasty Trade account. After we connect our account, we click on selling puts as our strategy, and we can set it up exactly as we did earlier. We have 90 delta. We can sell as many puts as we want. Let's just say one for now. Let's say I have a larger account size. I'll do it on the ES futures. I can do it once a week on Wednesdays, or I can do it twice a week on Tuesdays and Thursdays, which is a great strategy. I know a lot of great traders who do this. we're going to target, or I mean, a 10 delta will be our target, sorry. And 90 days until expiration will be the level, or not the level, but our expiration period. We're going to do a take profit of 25% and a stop loss of 400%. This is what helps set us up for the exact same result we see here, a $1,000 profit. And so that's kind of how we're structuring this trade. Next, how do we avoid these market crash periods? Well, like I said, when you push into the band and we hit it, and we want to avoid this selling off like we did in 2016, 2018, and the 2020 crash, we all avoided those. Well, you can do that automatically here. But first off, let's set up our buying power allocation, 50,000, and then our market crash, we click enable. Now, enabling the market crash will take us out of our long positions and not allow us to enter any new ones when we are in that crash period and crash phase, so that we don't have those massive losses like we see here. It will avoid that, so we have a much flatter and smoother profit curve. And so just like that, enable safeguards, and we've created the auto trader just like that. You can see here we now have an auto trader for selling puts every single Tuesday and Thursday. That's how that works following this result. And so again, if we did this daily, we'd have $1 million profit, if not more, because we're avoiding crashes. But again, that's what you can do, and that's how you automate and use this selling put strategy.